Joining us for a further look on what's playing itself out in the market scene is Jacobus Brink from the Schmidt Family Office. Jacobus, always a pleasure. Good afternoon.
Good afternoon. Always a pleasure to join.
Fantastic. It looks like a bit of a quiet day. I think markets are still contending or sulking over interest rate cuts and the outlook there. Jacobus, keen to get your thoughts on what we're seeing driving participants today.
Yeah, no, I think it's been quite a few interesting days over the past since about Friday. When the interest rate markets globally almost completely repriced. I think some of the moves we've seen in these rates were quite staggering, especially if you just take sort of the move from Friday to, I suppose, yesterday could also include, but yeah, Friday, Monday. Massive moves, especially in the front end of the curve. In the US 2-year rates, we saw a big jump there. Those are sort of a typical proxy for what sort of near-term rates are doing. And there's been a lot of Fed speak going on. Coupled with that, we saw two Fed speakers yesterday. There's some more lined up for today, and it sort of seems that they have pivoted from their pivot that they pivoted to in December. So yeah, it's been all about rates over the past few days. Notwithstanding some of the more positive news we saw out of China this morning. So I think that's sort of buoying the markets to some extent. Obviously we saw some very large moves out of China over the past few days as well. On Monday, small cap shares were actually sort of halted in trading. They fell, I think, more than 8% on the day. So yeah, there's a lot going on. And then coupled with that, we still have some developments in the Middle East. So a lot sort of that the market needs to focus on.
I'm actually going to talk a little bit about, what we are seeing with just the interest rates here. We are pricing in that in the second half of the year, we'll see cuts, Jacobus. If we don't see those cuts, can we anticipate more jitters and more, repricing?
Yeah, and I think so. Clearly, as I mentioned earlier, we've seen the market, price quite a few. I think it was about 6 rate cuts, since sort of the start of December, and that has been walked back, post the Fed meeting last week by a lot of the Fed speakers, including Jerome Powell. But the market still seems extremely, positive about a number of rate cuts that we'll see this year. So yes, there is still a lot of positive news priced in, and I think any sort of any sort of indication that the Fed might be a little bit more hawkish in the market's currently pricing will definitely have a big effect on stocks. I think we are sort of very much priced for a great sort of dovish outcome, and yeah, I mean, part of the rally, or most of the rally we've seen over the past number of months has pretty much been on those rate cut expectations. But on the flip side, we have seen oil being particularly sort of sticky on the upside. That could start to filter through into possibly inflation remaining a bit more sticky. We saw the Reserve Bank of Australia actually taking a very hawkish tone and not ruling out the fact that they could possibly still hike rates again. So yeah, I know there's obviously a lot of differences with regards to a geographical point of view, but I still think a lot of positivity is priced into the market. So that'll definitely have a big effect. Should we start to postpone those expectations later in the year.
Let's also touch Jacobus on China here. Every time I see Kumba and some of our platinum miners down, I know that something has happened in China. Let's talk about China. It's a very uneven picture. I'm wondering if we are getting a little bit Chinese recovery fatigue is what I want to call it, where we're just happy or keen to see a constant picture, a linear picture of this recovery and not this constant back and forth. Or is that just not how it works? It is going to happen in a rather uneven way.
Yeah, no, China's an interesting one. I think we had a discussion about this yesterday. I think any lack of negative news will actually be seen as a massive positive by the market at this stage. There's just so much bad news priced in. You're looking at Chinese stocks, trading at multiples we haven't seen in a number of years. And I think, a lot of it is still, there's still some optimism baked in, with regards to fiscal support from government. Most of the strength we saw in the past day or two has chiefly been around, Central Eugene. It's a very large sovereign fund, and they were actually starting to indicate that they will be buying more local exchange traded funds to support the stock market. Along with that, we also saw the stock market regulators, scheduling meetings with Xi Jinping to discuss some more supportive measures. So I think all of these things are boding well, for sentiment around China. But that's the thing, it's currently pretty much driven by sentiment. Yes, we're still seeing some weak economic data around it, but I think at this stage it's a sentiment story, and that's driving flows into China. Once we sort of see a little bit of an uptick there, we've recently seen some institutional buying back into the country. That's obviously a positive. So hopefully that'll sort of continue going forward. But at this stage it's still a bit of a all over the place situation.
And touching on some company news now, Total Energies is a very interesting one. They've come out to say that their net adjusted income fell 31% compared to a period a year ago. It's very, very, I guess, surprising. But that oil price really under pressure, isn't it?
Yeah, I know. Oil is always sort of for me, remains a barometer on, as far as global economic growth is concerned. I think to a large extent the oil price is currently still pricing in weaker economic growth going forward. But we've seen obviously some of the supply cuts that we've seen out of OPEC plus countries, I think, have made it slightly elevated it a bit. And there's still obviously that big uncertainty around the geopolitical situation in the Middle East. We've seen some positives coming out of there of late, with regards to possible ceasefires as well. But currently oil is sort of very much range bound at this stage. Sort of on the Brent side, it sort of it extends toward the $82 a barrel, and down at the bottom sort of 76, and it's been sort of hovering in that range. So I think it's struggling for direction a little bit here. But there's obviously a lot of variables that could have an impact on it. At this stage it remains anyone's sort of guess where it's going to go.
Another interesting one I must ask you about is Toyota. We saw that one surge to record highs on the back of strong quarterly earnings, Jacobus. That's showing that, there's still quite a huge demand for Toyota, which is very interesting because they haven't necessarily completely moved to the other side with EVs. They have a very good range of hybrids that have been loved around the world. It might tell us that we are going to see hybrids being used as a transitionary vehicle, from ICE engines all the way to EVs, and Toyota's in good standing for that.
Yeah, no, definitely. Can't go wrong with Toyota. It's always been a reliable one, and now today it seems to be very reliable as an investment. It record highs post that earnings upgrade. We're also seeing some of the rivals that are also posting earnings soon, so that'll be interesting. But I think they seem to be managing this weaker momentum with regards to straight battery-powered vehicles, and we've seen a lot of scale back on rollout plans for EVs. There's been production cuts in production targets. I think Tesla obviously comes to mind. It's one of the only one of the Magnificent Seven that's currently down on a year-to-date basis. Strong financial performance for the third quarter. Japan has been an interesting one. Just of late, there seems to be a lot of interest in there. I think there's a lot of sort of changes as far as corporate governance is concerned. So Toyota is definitely one to keep an eye on.
Very interesting times indeed, Jacobus. I'm keen to get your stock pick. But first, before we do that, let's reflect on counters that may have found favor with your industry peers.
There's a company called Diageo that makes some of the finest whiskies and other things in the world. I'm a keen fan of a lot of their products.
I thought Chris was grabbing a whiskey there, but it's just water.
Yeah, mine, it looks like water. No, but I think it's just got an incredible portfolio of companies. It's really a global business in every sense of the word. So if you take, for example, if they talk about geographic diversification through North America or Asia, it's just a beautiful wagon wheel of different geographies, different countries. Good brand portfolio, quite tilted to whiskey, but quite recently, so it's a business we like very much, but it's always been a little bit out of reach. Chris was saying foreigners are happy to pay sort of 20 multiples for growth, and Diageo was just out of reach. Recently, they put out an update to say that the Latin American and Caribbean operations were experiencing some sales pressure. Share price came off quite a bit. So I think let's call it £28. You don't have to buy it tomorrow morning. Pick a level at £28. I think it's a great business. This year's earnings will be virtually flat at £1.65 or thereabouts. But I think thereafter it's back to 5, 6, 7, 8% earnings growth. And although the PEG ratio is more than 2 times, that's what you pay internationally. So it's a brilliantly placed business that I think is offering an opportunity.
We're actually going to pick a mid-cap property name, Dipula Income Fund. So Dipula, it's got about a 4 billion rand market cap. 65% of the portfolio is in retail, and then the balance is split mainly between office and industrial. The reason we like it, Dipula trades on just over a 30 times discount to NAV, and it's giving you about a 13 and a half dividend yield. So quite solid income perspective, and also you're getting at a discount to NAV. Management are aligned with shareholders. They've got a significant stake in the company. It has got a clean balance sheet, no funny cross-currency swaps, foreign operations, related party dealings, and the likes. And I think if you've seen some of the retail updates of late, the retail segment, specifically in the non-urban regions, is performing quite well. If you just look at some of the updates from Attack and Fortress and Vukile, so we do think that we're going to see quite a good update from Dipula as well. So the portfolio is performing quite well. It looks as if office has stabilized at these levels. So we're happy to pick up the yield from Dipula. And again, I think corporate activity, potentially an option in the name, just given some of the deals that we have seen in the sector. They do have a very strong portfolio as well. But I think we're not buying it for corporate activity. That's just a nice cherry on the top. We're just happy to get the yield and some kind of discount narrowing on the price to NAV.
ASML, you not heard the name, but you obviously use their products. Basically, this thing has a monopoly almost on high-tech chip machines that make high-tech chips. So if you look at a company like NVIDIA, look at a company like AMD up 100% over the last year, NVIDIA up 200% over the last year, ASML up 36% over the last year. Whereas AMD and NVIDIA may not be guaranteed winners in the AI chip space. People do think NVIDIA is going to be the winner, but AMD is also doing well. The one guaranteed winner is going to be ASML, because these are the guys that make the chips for machines for both companies. And also some of the stuff happening around Taiwan means that people are going to build excess capacity in the US and Europe, etc. Also good for ASML. So AI, political movements, geopolitical movements, very good for this company. And like I said, it has not run anywhere near as much as the chip companies themselves that have run, like I said, 200, 100% over the last year.
All right, Jacobus, adult beverages, property, chips, all of it on the cards today with DHO, Dipula, and ASML. Keen to get your thoughts on some of those.
Yeah, no, 3 interesting, diverse picks, all of them. I think, sort of maybe a comment in general, we've been seeing the mid-cap local space as quite an interesting one, over the past year or so. And I think, that is going to remain interesting this year. There's obviously a lot of opportunities there. I mean, especially in the real estate space. And if you pick up a counter like this, the 30% discount to NAV, paying the healthy dividend, and we've seen a lot of those companies sort of remain under pressure over the past number of years. So I think a good one here. A comment maybe sort of on the general AI thing. Yes, NVIDIA has been an amazing performance. I mean, it's still sort of completely sort of blows my mind if you just look at that thing's performance last year and year to date. Maybe a comment there on the outlook. I think it's currently pricing in, yes, there's still a lot of revenue growth. The numbers are amazing that they're putting out. But what is interesting to see is that NVIDIA's 4 largest customers who make up 40% of their sales are all working on their own silicon chips. So it's sort of, whether that outlook remains. There's been a lot of talk in the media of late, comparing it to the Cisco's of the late 90s. Funny how the share price has sort of followed itself, but I mean, Cisco was also a very profitable company back then. So interesting one to, remains to be seen whether they can actually keep on growing earnings at the way they are at this stage. So yes, AI amazing, but I think a little bit overdone maybe. I'm not saying it can't go to 1,000, but yeah, let's see.
Keen to get what counter you're loving today.
Yeah, boring one, but I think it's a very easy sort of China play. You know, I think there's a lot of sort of positives going on in China, and as I mentioned earlier, you know, I think if we actually just get a lack of bad news, it could be a very, very positive headwind. You know, and this is specifically a play on Tencent. You know, I think Tencent is an amazing business. You can pick it up, you know, via nice spares at a discount. And yeah, I mean, the infrastructure is just amazing. We were in China not too long ago, and I mean, the China that you see on the ground is just light years removed from sort of the Western media sort of view we get of it. So I'm still a China bull, and I think that's an easy way to get some China exposure.
Very interesting insights there, Jacobus. Always a pleasure. Thank you so much for your time today. That was Jacobus Brink from the Schmidt Family Office.